Welcome to the Deep Dive. Here at Talk Tickers, our mission is simple. Cut through the earnings call jargon, get straight to the critical insights you need.
Exactly. No drowning in data.
Today, we're taking a closer look at Danske Bank's results for the first half of 2025. It's more than just the numbers, isn't it?
Absolutely. It's about understanding their strategy, the underlying currents, and really how they're navigating what is, let's face it, a pretty complex market right now.
We'll dig into their financial health, strategic plays, all of it.
Yeah, think of it as peeling back the layers. What's really driving performance? What does it signal for the wider Nordic financial scene?
Okay, so let's start with the headlines. A quick snapshot for Danske Bank, H1 2025. Net profit reported at 11.2 billion Danish kroner.
Which works out to a return on shareholders' equity of 13%. Pretty solid.
Yeah, solid numbers. Were they expecting that?
They were, actually. Right in line with their expectations, keeps them on track for those 2026 targets they've set out.
Okay, but you mentioned solid, yet I see the net profit was actually slightly lower year on year. What's the story there?
Good catch. It was slightly lower, but it's not necessarily a red flag. It boiled down mainly to two things: a dip in their insurance business results and a shift from net loan impairment reversals.
Reversals meaning they were getting money back they'd previously set aside?
Exactly. They were releasing some reserves. Now they've shifted back to taking small new charges. It's more of a normalization, really, a return to typical credit operations.
Got it. So normalization, not weakness.
Okay.
And the core business, lending and deposits.
Looking healthy there. Lending was up 5% compared to last year. Deposits saw a 3% increase over the same period.
And the cost-income ratio, always a key metric.
Hold steady at 45%, right on their target.
45%. That's pretty lean, especially with costs generally rising and them talking about investments. How'd they manage that? Feels like there must be some efficiencies going on behind the scenes.
You're right. That's a really important point. That 45% isn't just good luck. It shows they've been successful with internal cost takeouts. They've managed to absorb things like wage inflation, ramp up investments.
Without letting total costs get out of hand.
Precisely. It shows really effective operational leverage. That's a big advantage in banking. Their total operating expenses, around 26 billion DKK for the half, are tracking perfectly with their full-year guidance. And importantly, those financial crime prevention costs are coming down, normalizing as planned.
That's good news. Okay, fantastic. Let's dive deeper now. Pivotal financials, performance drivers. Net interest income, NII. That core banking profit metric. How did that look?
Incredibly stable. That's the headline. Stable year on year, stable quarter on quarter.
Which is impressive given, interest rates have hardly been static. What's keeping it so steady?
It's fascinating, actually. A big part is continued positive volume growth, especially on the corporate side, strong loan demand there. But the critical piece is how they're mitigating the impact of rate cuts using their structural deposit hedge.
The hedge is doing its job then.
It really is. They also nudged up their bond portfolio hedge slightly to about 160 billion DKK. This kind of proactive hedging is vital, particularly as deposit margins start getting squeezed near that zero bound we talk about.
Meaning less room to pass on rate changes to depositors?
Exactly. So Danske is actively managing that risk, which really supports the NII.
Okay, so NII looks very robust. What about fee income? That often gives you a sense of customer activity, market sentiment.
Yeah, fee income tells a bit of a mixed story. Year on year, it was stable, actually up 2% if you adjust for a couple of one-off things like a divestment.
Okay.
But Q2 saw a noticeable drop, down 7% compared to Q1. That really reflects the market volatility we saw. It hit customer investment activity. People were just less keen to invest.
Makes sense.
And there was also less mortgage refinancing activity. But the flip side is everyday banking stuff like payment services actually showed good momentum, up 3% against Q1 and last year.
So market caution hits some areas, but the core banking activity provides a base.
That's a good way to put it. It highlights that sort of dual nature of their revenue streams.
And net trading income, did that follow fees down or?
No, trading income went its own way, up a significant 26% year on year.
Wow, okay. What drove that?
Higher customer activity in their large corporates and institutions segment LC&I, and also some positive market value adjustments on their books. Even though Q2 dipped slightly from Q1's very strong level, it was still a good result, helped by a one-off gain from a sale.
So strong engagement from the big clients.
Yeah, that's a key takeaway. Good activity in their wholesale banking franchise.
Right. Now let's talk credit quality. Always crucial for a bank. Impairments.
Credit quality looks, well, remarkably strong. Impairment charges were only 0.3 billion DKK in the first half.
0.3 billion, that sounds low.
It is well below their full year guidance, which is around 1 billion.
Yeah.
It really speaks to their lending standards and, the relatively resilient economies they operate in.
And are they just benefiting from the conditions or being proactive?
Definitely proactive too. They reviewed their impairment scenarios, even added a new downturn scenario alongside this severe downturn one they already had, just for extra robustness in their modeling.
Building in more caution.
Right. Plus, they actually had some micro-model reversals, small releases of about 70 million DKK in the quarter, and released 0.2 billion from another buffer, the PMA buffer. Basically, they feel comfortable enough with the credit outlook to release some prior provisions.
Okay, very solid picture on credit. What about capital? Always top of mind for investors.
The capital position looks exceptionally strong. Their main measure, the CET1 ratio, actually increased. It's up to 18.7% from 18.4% in Q1.
And how does that compare to your requirements?
They have a huge buffer, over 400 basis points or 4 percentage points above the regulatory minimum. Their own target is just to stay above 16%.
So plenty of flexibility there.
Absolutely. For growth, for shareholder returns like the ongoing share buyback program, and just to absorb any unexpected shocks, it underscores their confidence.
Okay, let's shift from the pure numbers to the strategy and management commentary. What did they say about the big picture, the macro environment?
They described it as strong, actually, particularly in Denmark, where they see a pretty healthy 3% GDP growth outlook for 2025.
Despite all the headlines about geopolitics and sentiment.
Yeah, they acknowledged the geopolitical turmoil and noted low consumer sentiment, but said the underlying resilient macroeconomy has really supported their business and, as we saw, their credit quality. Their core markets seem to be holding up well.
Interesting. And how did that translate down to the different customer segments? Personal banking first.
For personal customers, they saw deposit growth, good activity levels. But like we touched on with fees, they did feel the pinch from rate cuts on deposit margins and that lower appetite for investments.
And mortgages. Housing markets have been volatile.
Home loans were stable overall. They highlighted growth in a specific product, Benitri, which seems to be an innovative financing solution that helped offset broader market declines, particularly in Denmark.
Okay, and business customers.
Core banking income there was up 2%. That was driven by solid lending growth, up 1% quarter-on-quarter, 4% year-on-year, and they actually expanded their customer base across all 4 main Nordic countries.
So growth across the region.
Yeah, and they pointed to their continued investment in digital tools and upskilling their sales teams in that segment. Seems to be paying off.
It sounds like digital investment is a running theme. What about the big end of town, large corporates and institutions, LC&I?
LC&I delivered solid results too. Lending volumes there were really quite impressive, up 10% year-on-year and 6% just in the last quarter.
10% year-on-year, wow.
Yeah. They reported gaining market share in corporate lending across all the Nordic countries, and they also expanded their cash management business. Overall income in LC&I was up 8% compared to Q2 last year.
So consistent growth, particularly corporates, seems their focus there is working.
It really does. It's a clear sign their strategy is hitting the mark and maybe giving them an edge.
And they keep mentioning technology investment, part of that Forward 28 strategy. Now, everyone's investing in tech, right? Is what they're doing enough to really stay ahead? Or is there a risk they could get caught out later?
That's always the question, isn't it?
Yeah.
The investment is crucial, sure, but it's the execution that matters.
Yeah.
And the ability to adapt. Their cost management suggests they're agile, which is good.
But agility isn't enough on its own.
No. Staying ahead means constant innovation. Using tech not just for efficiency, though that's important, but to genuinely improve the customer experience, offer new things. They did mention looking at AI for productivity gains in the medium term.
Which sounds promising for future efficiency.
It does. It's an important signal they're thinking ahead about streamlining operations further down the line.
Okay, let's turn to the outlook then. What did they actually guide for the rest of 2025?
They basically reiterated their existing guidance. Net profit outlook remains in that 21 to 23 billion DKK range for the full year.
Okay, no surprises there.
Total income expected to be slightly lower than 2024, but that's driven by that resilient NII we talked about and a continued focus on trying to grow fee income.
And NII specifically, did they update that?
They reaffirmed the full year NII guidance above 35 billion DKK. They feel the volume trends and that structural hedge will support it, even with ongoing repricing due to rate cuts.
And loan impairments.
Still guiding for around 1 billion DKK for the full year. And importantly, those 2026 financial targets, They remain unchanged. So stability, consistency for investors.
Right, sticking to the plan. Any hints about longer-term targets or how they plan to use that strong capital position?
Updates on targets beyond 2026 are flagged for Q1 next year. On the capital front, an update on the distribution strategy, think buybacks, dividends, is also planned for Q1 next year.
So we wait until early next year for clarity there.
Seems so. They did say their first priority for capital is growing the business, and they're also waiting for this observation period with the U.S. Department of Justice, the DOJ, to finish up towards the end of this year. That could influence things.
Ah, right, the DOJ situation. That makes sense. And what about the competitive landscape? Are things getting tougher? And regulation?
They described competition as, well, healthy but not dramatically different. They emphasized their own consistent approach to credit and risk, basically saying they won't chase risky growth just because others might be.
Playing the long game.
Seems like it. On regulation, they sounded pretty comfortable. They've already front-loaded the impact of CR3, that's a set of new capital rules.
Right, Capital Requirements Regulation 3.
Exactly. So they don't expect big competitive shifts from things like output floors, which limit how much banks can benefit from their internal risk models. And Basel IV, the next big regulatory wave, is still quite far off 2032, 2033. They're monitoring talks about European competitiveness and simplifying rules, but no immediate concerns there.
Okay, so let's try and pull this all together. We've seen strong underlying performance, pretty effective risk management, but also some headwinds from market jitters and those rate cuts. What does this really tell us about Danske Bank's position now? How should, an experienced investor read these tea leaves?
Well, what really stands out is that resilience in net interest income. Despite rate cuts, it held up thanks to volume growth and especially that structural hedge. It really points to a robust, quite sophisticated balance sheet management strategy.
And that detail about NII sensitivity near the zero bound.
That's critical, yeah. It flags the challenge banks face when rates get very low. You run out of room to pass cuts on to depositors. Danske's proactive hedging here looks like a key differentiator compared to maybe some peers. It shows they can navigate these tricky market dynamics.
Okay, here's something that caught my ear. Management sounded quite hopeful about fee income recovering in the second half, expecting investment activity in capital markets to pick up. But they also noted how cautious investors were in Q2. Is that optimism justified or maybe a bit wishful thinking? What's your take?
That's a very fair question. Are they being too optimistic? I think you have to look at it alongside their actions. They're continuing to invest strategically in advice, in digital. They're focused on gaining market share across the Nordics. This suggests a long-term view that isn't just based on hoping the market turns tomorrow.
So it's underpinned by strategy, not just hope.
I think so. And look at their ability to grow lending faster than the market, even with all the uncertainty around. That signals real operational effectiveness, right? Plus, that point about front-loading the CR3 regulatory impact that genuinely puts them in a more stable position than potentially some competitors who might face bigger adjustments later.
So managing regulatory risk well could become a competitive advantage.
Exactly. It could lead to more stable returns down the line. So less about pure optimism, more about, strategic positioning for the future.
Okay, this brings us to the really interesting part. What does all this mean for potential opportunities? We've dug into the call now for some, let's call it creative thinking. And remember, everyone, this is purely for discussion, absolutely not financial advice.
Gotcha. Not financial advice. Okay, so given Danske's strong capital, that NII stability from the hedge, and how they're ahead of the game on regulatory capital, here's a thought. What about a pair trade? Long Danske Bank and shorting a European peer.
Okay, which kind of peer?
One that looks like it might face significant capital shortfalls because of upcoming rules like Basel IV. Danske explicitly said they front-loaded CR3, they have that big buffer, they seem well prepared.
Whereas others might need to raise capital or face headwinds.
Potentially, yes. That could lead to underperformance for the short leg of the trade. Danske's foresight here, managing that regulatory risk, could translate into a sustained advantage and more stable returns. So it's sort of a defensive long position against a potentially more vulnerable competitor. An interesting idea, anyway.
Definitely food for thought. Okay, so to quickly recap our deep dive today, Danske Bank, a solid first half. Key strengths seem to be that remarkable NIR resilience, tight cost control, and strong credit quality.
And their strategic focus on corporate lending growth and digital investment really seems to be paying off.
Understanding these nuances, the NII sensitivity shifts, the long-term capital plans, it's crucial to really grasp where Danske Bank stands.
Totally agree. They're managing the short-term bumps while clearly building for sustainable growth down the road.
Well, we hope this deep dive has given you some valuable insights into Danske Bank's performance and where they might be headed. We're Talk Tickers, your shortcut to staying informed.
So what stood out to you in this analysis? We genuinely love to hear your thoughts.